The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. Today I'm going to talk about some things you already know. Then I'm going to look at some new indicators that I think are worth your attention. And then we'll talk a little bit about construction sentiment, the Architectural Billing Index, interest rates, and overall markets. So first of all, things you're already aware of is the unemployment rate is extremely low, and it continues to be a big challenge finding skilled workers in the construction market. Also, you're well aware of oil prices and the increase in fuel cost. We see a 68.79% increase in oil prices over the last year, and it continues to go up 7%, more than 7% in just the last month. Lumber prices had moderated, and they're back on the rise, up 2.66% over the last month. Iron and steel prices and asphalt and paving mixtures up as well. Surprising numbers on the new housing starts, or maybe not so surprising when we look at mortgage rates. New housing starts have fallen quite dramatically here in the latest number. So we are seeing the increase in mortgage rates start to affect the residential new housing market, and remains to be seen what to the degree to which existing home sales will be affected, although we're starting to see some softening in that market as well. One of the things that can be a reliable indicator of potential recession is the interest rate that banks and institutions charge companies on loans. So if we look at companies with a good credit rating compared to companies who have a distressed or high yield credit rating, higher interest rates that are being charged to those companies because of higher risks of default and bankruptcy, what we see is during periods of potential recession or when concerns of recession go up, that differential in interest rates goes up. We see that going back to when the tech bubble burst in 2000. We had 9/11 in 2001, and then the Enron and WorldCom and a lot of other recessionary issues in 2002. We had a banking crisis in 2008. We had the COVID recession here back in 2020, and we see big spikes in that credit yield, that high yield spread during those periods. And high yield spreads are something we're watching very closely because they're on the rise and they've gone up pretty significantly. Something definitely to pay attention to and to continue to watch. Construction sentiment, though, remains strong. We see higher backlogs in construction now than we did a year ago. And those numbers continue to look good, even translating into the Architectural Billing Index. We see a strengthening, particularly in the Northeast, and we see not only inquiries, but design contracts continue to be in expansion mode, and then the actual billings also continue to be expanding. So those aspects of the construction market look pretty strong. Interest rates, as you know, have increased pretty significantly here. We do see the differential in interest rates, actually the 5-year government bond paying a higher interest rate than the 10-year, which is a yield curve inversion, something that you'll hear professionals talk about as a recessionary indicator. So another concern there that we're watching very closely to see what the economy is going to look like going forward. A lot of people are noticing their investment portfolios are seeing a much more significant decline than what we've seen in some past market events. It's been common for stocks to drop big during periods of recession in the past, but typically bonds hold up okay. So a diversified portfolio tends to be down, but not down dramatically. And what we see now is the bond market over the last 12 months has actually performed worse than the stock market. Now the stock market is down more recently here, but over the last 12 months, bonds are actually down more than stocks. So we see a situation where virtually all categories of investments, from large companies to small companies, real estate, bonds, all down at the same time. So diversification hasn't helped as much as it traditionally would, and so we're seeing pretty significant declines in markets. Again, a good time for companies to hold a bit more in cash, be a little more cautious, and if you'd like for us to talk about your business prospects, review your investments or your 401k, please reach out to us. We're happy to chat. Thanks.